This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week.
It's astonishing the degree of consensus that I see within central banks, because I look at data that's highly contradictory, and it's at times actually surprising to me how little dissent we've seen. I would not take it as a bad thing in and of itself to see more of this divergence of views, because this potentially is a fundamentally altering force for the trajectory of productivity, growth, but also labor displacement. What does it mean for policy, right? If growth is 3, inflation is 1, unemployment is 5, what should you do?
A lot was made last year about the higher level of dissent within the Federal Reserve, especially in the context of rising political pressure. But dissent isn't necessarily a bad thing. It certainly isn't limited to the Fed either. Last year, the Bank of England had to have a tie-breaking second vote on its policy rate decision. And that institution remains very divided right down the middle to this day on whether or not to ease further. And as I discussed with this week's guest, Simona Mocuta, chief economist at State Street Investment Management, we should certainly expect at least a lot more debate over the U.S. and global economy, and from all central banks, not just the Fed, especially when it comes to how the adoption of artificial intelligence tools to the workplace will affect labor markets, consumption, and inflation. Debate and dissent are features of the process, in other words. They're not bugs. Simona and I also talk through the current state of the U.S. economy, what Kevin Warsh will bring to the Fed when he takes over as chairman, most likely in the spring, and how all central banks will likely need to refocus on targets within their grasp and away from those outside of it. Hello.
How are you?
I'm good. How's it going?
Good.
Well, Simona, thank you so much for coming back on the podcast. It's been a few months. I wanted to let's start with the U.S. I mean, we might talk about some of the other big factors in the global economy this year, but let's start with the big one, the U.S. And, it's been a pretty hectic start to the year. We've had many government shutdowns, some delays of data. We're still dealing, I think, with some of the after effects of delays of data from last year's shutdown. Can you just kind of level set where we are with the U.S. economy? What's the story at the moment?
Well, the story is pretty good, despite all the headwinds, all the policy shocks, all the uncertainty, all the bad things that should have pushed you into a corner. Actually, I think we are doing okay.
Yeah.
And that's probably the biggest surprise of all, right? I think everybody is continuously positively surprised to the point where you start wondering how long this continues. But for the time being, yes, I think we are, not so much us because we've been more constructive on the outlook, but clearly you see consensus views on growth projections for this year move up meaningfully, right? Even over the last month, 4/10 in 1 month, it's a lot, right?
Yeah.
So we used to be very upside to consensus. If when we last talked, I think middle of last year, we were much more upside to consensus. Right now, consensus has caught up to us, and it's a very strong, mid-2 growth projection for 2026. What's not to like, right?
Yeah. What are the big drivers of that, and in particularly the revisions? And part two, or maybe related to that question, is the notion of a K-shaped economy, which has become sort of a very consensus thought. I think everybody kind of believes there are two speeds to the U.S. economy, depending on where you sit within it. Do you have thoughts on that, and what is contributing then to the better sense of we have around growth for this year?
It's not a thought, it's a reality. It really is a reality, and it makes sense to talk about it. We won't change it by talking about it. So, I think the way you have to think about it is what weighs more. And in the ultimate analysis, the scales are still skewed towards stronger growth because the wealthy are doing okay. At the same time, you're wondering, and I think this is perhaps a story that was less visible last year, but will become more visible this year. which is this idea that you can have strong growth. Going back to my comment earlier, what's not to like? Well, there is something not to like very much, and that's the state of the labor market. And that is where the downside risk lies in regards to this very idea of a K-shaped economy, because for the lower income consumers, the main source of income is labor income, right? So the stock market can be doing great, your assets are fine. If you lose your job, that threatens the lower end of the consumer. And so far, that has perhaps been struggling but not given way. So if there is one thing I worry about, and one thing I'm watching very carefully is what happens to the labor market, job creations. And that's where the incoming data has been a little more shaky. So K-shape all the way. We're still going to talk about it, and a year from now, that it is
Yeah.
what it is.
We did have last week quite a lot of data, not the payroll data. We're recording this
Mm,
the couple days before the non-farm payroll data for January come out. It'll come out the day after. So we don't know what that number is going to be. We have a decent sense of it. But last week we did have JOLTS data showing that openings are way down. We had some of the
mhm.
Challenger layoff data that show maybe there is some weakness. I mean, do you read this as a movement from the no hire, no fire economy to actually something a little bit more worrisome? Or is this also just a function of, labor supply issues are getting talked about a lot? Where do you fall out on this in the terms of the direction of travel?
So you know me, I never take any single data point,
Yeah.
and make a mountain out of it. However, in this case, you're not talking about a single data point. And even if you have a view that, the government shutdown has distorted some of the data, give it some months for things to normalize. It's been now, 6 to 9 months of broadening evidence that labor demand is softening. And for a while, indeed, you were in that no hire, no fire situation. But over the last few months, you've also seen a little bit of an uptick in layoffs. The issue that is highly relevant, but we cannot fully quantify in this regard, is the impact of labor displacement due to AI adoption. And the fact of the matter is, this is a huge potential hit that multiplies and intensifies over time. So it's not like, oh, I give it 3 months, 6 months, and then I get over the hump. Potentially in 6 or 9 months from now, there would be more impact from that space. And I cannot tell you what the numbers are. And honestly, I don't think anybody does. But you can envision this sort of almost like a J curve where, like, at the moment, so many companies, everybody's investigating, exploring, perhaps doing some small case studies here and there internally in one department or another, trying to figure out how to utilize these tools and what can they then save in terms of labor resources, right? And over the next, I don't know how many months and years, you have to believe that the investigation turns to application, right? So at that point, you run the risk of having a larger impact down the line. I think you're already seeing some of it in the numbers. The softness in job creation, I attribute some of that to this effect, but it probably intensifies over time. And to that point, I thought it was very telling that, obviously Governor Waller also descended in favor of a cut in January, right? So they have their opinions, and you always, typically it's more like, well, the balance of risk, this and that. And it's a very tame kind of a language in those dissent explanations. In this case, I was actually struck by the intensity of his language in regard to the vulnerabilities in the labor market. So at the very least, I would say watch that. Last year, you mentioned the labor supply story. I've always been of the view that, it's going to take a while for the labor supply to really play out, because you did have some excess supply, from the domestic sources. And now I feel like that may still be a phenomenon, but it's overwhelmed by this other phenomenon about labor displacement. So at the end of the day, I say, where do you see what's the proof? The proof is in the cost of whatever commodity you're talking about. In this case, wages. Wage inflation
Mhm.
is moderating, especially in the context of productivity. So I see no sign of genuine tightening, nor do I expect that to happen. If anything, I'm more worried about unemployment rate moving higher in the high fours by the end of this year rather than, falling back towards four.
Yeah. that brings us to, and we're going to talk a lot more about the choice of Kevin Warsh as the next Fed chair. As a sort of prelude to that, it's pretty clear, or it seems as though it's clear, that the discussion in the media, at least, is that he's going to come in. He wouldn't have gotten the job if he wasn't going to ease policy. We can kind of take that
Mhm.
as read. But there are good reasons to think that you might have the ability to ease policy based upon the labor market argument you just articulated, that Waller highlighted in his remarks last week, but also productivity, allowing you to kind of have this disinflationary growth environment. I mean, accepting that productivity is a very, very nebulous concept, a residual of a residual almost.
Mhm.
Is that enough to sustain the growth outlook itself on its own, even if labor income growth is weak and there are gaps in the labor market and displacement, actually, the better word that you use, displacement in the labor market?
I think up to a point, yes. But let's remember that the consumer is two-thirds of the US economy, right? So obviously not all consumers get displaced, right? But if enough of them do, then you might have a problem. I don't see this as a 2026 issue. I would also not necessarily view the productivity benefits as the rationale for allowing further rate cuts. I mean, maybe it's a good time to update, our views, which actually have not changed in terms of, how many cuts this year. We have three cuts
Hmm.
in 26, and they are irrespective of, frankly, who's at the Fed helm. That should be emphasized and maybe double underlined there, because not every rate cut is a function and a result of political pressure. I think we do
Yeah.
ourselves a disservice if we frame everything in that context. The inflation picture continues to improve. There is sheltered disinflation that extends into 26. You get at some point in the second half of the year past that, moderate but real tariff impact on inflation. So you have the ability to calibrate a little lower, especially in light of these growing risks in the labor market. So that's where the cuts are coming from. I think the productivity question will really be able to answer more over the medium term, and it does speak more to what is the ultimate terminal or neutral rather than what's the trajectory for rates in 26.
On the inflation side of things, then, based on what you've said about the labor market and then the disinflationary factors you just mentioned, I mean, the Fed has a year-end forecast of core PC of 2.5%. Are
Hmm.
you suggesting that we miss to the downside of that to get further easing over the line?
A little bit. I mean,
Yeah.
I have to believe my own forecast team.
Well,
So
yes, of course.
yeah, my forecast is for 2.3. So not a
Okay.
whole lot different, right? I mean, modestly below the Fed. But again, let's keep in mind that when you do policy, you don't do policy for the moment in time where you find yourself, right? So
Yeah.
it's really, again, looking over the horizon and into 27. The idea really is, in a very simplistic way, that you want to move to get to neutral. This is not an economy that requires restrictive policy stance. We viewed neutral to be three. So you're like going, three cuts take you there and you settle to figure out where things are. It doesn't mean that's the ultimate endpoint. Depending on how things play out, you may cut more if you find that you need it, but that's what we have in our forecast. So a little bit, room to for more progress on inflation, perhaps, than
Yeah,
what the
well,
Fed
yeah,
has
it
said.
makes sense. If you have a more aggressive forecast than the Fed themselves are projecting for rates, then you probably think inflation gets back to target faster. I suppose that
At
makes
least I'm
sense.
internally consistent, right?
Yes, exactly. I was trying to catch you out, but never can do that. Last question on the U.S. The sort of outlook is kind of bringing it back to growth, and we know that fiscal policy is a massive factor where growth in the U.S. has been. I mean, it's very difficult to envisage a recession happening in an economy running 6% of GDP deficits, where corporate capex, particularly from the tech world, is as strong as it is. So do you expect any kind of give back from that? I mean, the growth forecast, put it another way, the nowcasts for Q1 are running very strong as they were at the end of last year. And the overall growth forecast for the calendar year is around 2.5%, having been
Hmm.
revised up, as you mentioned.
Yeah.
So does that mean we get a pretty sharp give back in the second half as those fiscal policy effects kind of fall out?
I don't think so. And the reason I say that is, the fiscal is sort of a bit of, there's a direct element there, but there is an indirect element through capex incentives. And those CapEx plans don't, come on board, materialize, and dissipate in the span of 6 months, 12 months, right? These are
Mm,
multi-year projects. I know there is a lot of talk about, the AI, the data center investments, but in many cases, funds may be committed, but really, you're just starting to dig in the ground. So
yeah.
if you look from a macro standpoint and keep in mind realistically how long it takes for these projects to complete, I think payback in 20 back end of 26 is way too soon.
Well, let's now talk about the new Fed chair. You
Yes,
had the
let's.
selection.
Why not? Why not?
Why not? It's the big topic. It is probably the big news topic of the US economy for this year, the choice of Kevin Warsh. You have written a lot of really good notes on this, so I wanted to spend probably most of the rest of our time on this. This has been pretty well accepted by not just the political community with which or from which this selection came, but the policy community has really, I think, responded quite favorably to his choice. What stands out to you as the most appealing, and also maybe the things we need to watch out for, those aspects, maybe of the political nature of his selection that really jump out to you?
Well, I think two things. On one hand, I would say his choice also eliminated other choices, which perhaps might have been perceived as less compelling, let's put it that way. So it's not that just an absolute choice, but it's a relative choice. And the relative choice, I think, was a good one. You clearly bring somebody with a lot of experience in this space and credibility. And then the other element is really perhaps this idea that we should be willing to entertain the question of should changes be made. I feel like one thing that happens right now is like every talk of any change to any element of the Fed, either mandate or policy tools, tends to have an equal sign to undermining of Fed independence. And again, I don't think this is the right way to think about it. Perhaps the question I would suggest to our audience and any analyst is, would we say that everything is ideal in the current state, of macroeconomic and monetary policy making? If it's ideal, then you perhaps are entitled to the view that do not touch, do not change, do not talk about change. But if it's not fully ideal and there are places where you can tweak for better effectiveness, then maybe we should have those conversations. So I think in the sense that this is a person who clearly is willing to have those conversations, let's have those discussions and let's see what transpires at the end of the day and not prejudge the outcome.
Based on what you've seen so far from him in the policymaking seat, but also his role just commenting on policy over recent years, what sort of changes do you think will be most strongly advocated for?
I really think it comes back not so much to interest rate policy but to
Yeah.
balance sheet policy. Again, the current setup really reflects the experience of the great financial crisis, right? If you look at, even bank reserves as share of GDP, like pre 2008, post 2008, very different world. And the question is, are we still in the 2008, and the decade that followed world, or are some of those issues, have they been corrected? Are we now at risk of perhaps overcorrecting for them? And maybe some of the regulatory attention and risk management should be focusing on non-bank institutions, which are growing in importance in the economy. So I think these are the questions that I think will be more central to the discussions. Are we overly restrictive, over regulation? Are we expecting too much from the Fed when their tools are frankly very indirect in terms of impacting short-term outcomes in the economy, right? Should there be more coordination and between monetary and fiscal policy? Is that idea a bad idea in all
Mm.
circumstances and to all extents? I happen to think that, monetary and fiscal policy are two tools that operate in the same ecosystem, right? They're not in two different universes. They should talk to each other. They should coordinate. They should try to pull in the same direction. Of course, you want a degree of coordination. You don't want subservience. I think that attention and care and concern should be there, and those worries should be voiced just as guardrails. But we should not kill the debate altogether.
And I think that's the key word you use is subservience. And I think that's most likely what's going to be avoided. And as you say, this is not a new concept. And the notion of questioning Fed independence really shouldn't be taking place under one party. We have, it is a politically appointed body.
It really is, it's fine to have a clear mandate of setting interest rate policy, right? When that mandate broadens into decisions and actions that then influence the allocation of capital throughout the economy, then you wonder whether that is still part of the true Fed mandate, right? Or if
Mm,
it's just under the guise of crisis management and let's do something. You do something, you acquire these new powers, they become sort of embedded in the expectations for the future. And once in a while, maybe it's good to revisit whether you go back to a more basic approach. As with all of these things, what gets done and how it gets done are equally important, and only time will tell, really. I think directionally, I agree with let's talk about this.
yes.
And perhaps there could be better ways where some of the things that currently are being done via balance sheet policy can be done outside of the Fed in the private sector with equal or even more efficiency.
Beyond that, and I'm thinking here about both the Fed's stated mandate as well as the way it operates. And here I'm thinking of, whether it's the every 5 years they have the policy framework review, but there's also been changes to its mandate with respect to the search for maximum employment as a target as opposed to full
Mm,
employment. What sort of changes are we maybe not paying enough attention to that you think he might focus in on?
that's a tough question. I'm not sure I have a good answer for it, honestly, right now. I do think a lot of the attention will be focused on balance sheet policy in the early stages. We've had these discussions whether the inflation target itself should change. I don't think that will change. We've had some experimentation with the, broadest definition of full employment across subcategories. I think we realized that monetary policy is not the tool for effective accomplishment of those goals. And I think that lesson has been clearly learned. So I don't think we go back to dabbling into, expanding our understanding of what full employment means in that regard. So, I don't know that I have a good answer on this
Yeah,
one, to be honest.
yeah. Well, I mean, what about more generally, both for the Fed, but I wanted to also segue this a little bit into thinking about central banking more generally. Warsh has talked about the Fed specifically as, well, guilty is not the right word, but as engaged in mission creep. In other words,
Mhm.
it's gone beyond the scope of its stated mandate in certain areas, such as some of the ones we just alluded to. I mean, as a proposition, would you say that's correct? Is a central bank, should they aim at the wide expanse of remits that they've given themselves over the years? Should is like
Uh,
that's a normative statement, but
I think probably not. And
yeah,
the reason I say that is not that you should not have an interest in
yes,
aiding the achievement of those goals, but you have to ask yourself whether the tools that you have available are the most effective ones. Because at the end of the day, right, if the Fed operates on a very indirect fashion, right? Interest rate policy is a kind of a diffuse type of instrument. And the errors that happened and the cost that became visible after COVID during the recovery was you kept interest rates very low in the hopes of reviving, getting back to full employment and all of that. But there was a cost, right? you
mm,
you facilitated you know inflation, you facilitate asset price inflation, at the end of the day you can argue you exacerbate the K-shaped economy, to go back to that concept we just discussed earlier, right? So you are trying to accomplish something here, but you're causing damage over there. So in that sense, I think perhaps the way I would describe it is more awareness of unintended consequences. Not that you shouldn't think about trying to accomplish and help with these goals, but be more mindful of what may transpire that was not part of the original plan.
do you think we as market participants and observers expect too much of central banks along those lines? We just expect them to solve problems, and
The magic wand that doesn't
well,
truly exist.
exactly, exactly. It's,
Yeah.
I mean, for years, and especially after the crisis, you had for years fiscal policy really acting with at least one hand tied behind its back. And as we
Mm-hmm.
saw following
Yes.
the pandemic, fiscal policy is where the real magic happens when it comes to, waving that magic wand and reflating economies. And I do wonder if, as much as I've in the past kind of critiqued some of his views, I do wonder if there is a point to be made about mission creep and us expecting just the world of institutions that have very limited mandates at the end of the day.
Yeah. I think in every crisis, you tend to make some kind of policy mistake in the rush to fix the problem, right?
Mm,
So I think in 2008, we recognized that we didn't do enough fiscal policy in the moment, right?
yeah,
And then when COVID came, we did too much fiscal policy. Right? So I feel like on both of this, it's like the conversation is relevant not just for monetary policy, but for fiscal policy as well. I mean, the amount of new debt that has been incurred in the last few years, right? That also leaves scars.
yeah,
So the same way that you are revisiting monetary policy and what's possible to accomplish without too many side effects, the same questions will be relevant to fiscal. I would say the what I take out of this is really we need to go back to a world where the private sector itself and markets themselves are given more of a role. You know what I mean? Less interfering with market pricing signals that should reintroduce more discipline. So on one hand, you have all these concerns about, maybe loss of Fed independence, just facilitates excess fiscal spending. But then actually, if you take some of that balance sheet and put it into the private sector, you have the market that has more of a role and an arbiter and can actually place some constraints even on fiscal policy, right? So a little bit more discipline is, I think, what we want, no matter which side of policy you look at.
yeah.
That's what I think is the desirable equilibrium level.
And that actually nicely brings me to what I think will be my last couple of questions is on message discipline. Because I think there is a worry, or there was a worry. I actually don't think it's manifested itself at all since his choice was announced, but that there might be dissent within the Fed. You have had some clear political elements aimed at the Fed over the
Mhm.
last 6 months, and
Have you noticed?
yeah, yeah. No, it's no, but I think those raise the very s salient questions of message discipline from the central bank and dissent within the central
Mhm.
bank, and there are a couple of questions along those lines. First of all, will he be a consensus builder, I suppose, is the right question here, or how strong of a consensus builder do you think he
Yeah.
will be?
I'd say again, going back to it's all relative, probably not nearly as much of a consensus builder as Chair Powell has been.
Mm,
And to be fair, as an economist, sometimes I actually wonder it's astonishing the degree of consensus that I see within central banks, because I look at data that's highly contradictory and I do struggle to make some of the calls. And I do believe that in some cases things could turn one way or could turn the other way. So it's at times actually surprising to me how little dissent we've seen. And I would not take it as a bad thing in and of itself to see more of this divergence of views because frankly the economy, and if again we talked about AI really just in passing, but this potentially is a fundamentally altering force for the trajectory of productivity growth, sustainable growth. Like, in a world where maybe you grow very fast, but these technologies prove to be disinflationary, but also labor displacement, what does it mean for policy, right? If growth is three, inflation is one, unemployment is four, or I mean five, what should you do? I
yeah,
think is not an easy question, right? So having those debates, I think, are fine. The how you position the consent, I think, will be critical, right? Like if you do not want to come away with a sense that this is a group that's arguing and fighting amongst themselves, right? If, as long as it's an intellectual discussion and it's validated by data that can be interpreted through a subjective like that's fine, that degree of subjectivity is okay. You don't want to be like complete chaos is nobody wants that, right? So dissent is fine, debate is fine, chaos is not. But I think the whole structure of the Fed, right, the whole committee structure also puts some constraints on whoever is the new Fed chair, right? And you have to work to create some degree of consensus, even if you may disagree. You cannot go from 0 to 100 and come on the table and say this is how it is. You're not going to get far with that.
And there's ultimately probably a bigger belief in the institution that you're working for that is
Yes.
damaged
Yeah.
should you do that.
Yes. And I think, that's where perhaps I've always been a little bit more constructive on this whole theme of loss of Fed independence. Perhaps I have more faith in the institutional resilience of the Fed. And, frankly, I think we've seen certain developments that I actually would call encouraging in that regard.
Well, on the topic of dissent, there is no dissent that I've enjoyed chatting to you for the last half an hour, Simona. It's always good to catch up, and it's always great to get your thoughts, as unique as they certainly are, relative not just to what the Fed is saying, but relative to what the market is pricing as well, a more dovish outlook, and one with all of these questions that we will certainly catch up with you over the coming months and coming years, I'm sure, when we have you back on. But thank you so much for joining us this week.
Always a pleasure, Tim.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. By State Street Bank and Trust Company, hereafter referred to as State Street, and is for informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.